Hello and welcome to opening a One Future Cash Balance Plan. During this short presentation, I will highlight what a cash balance defined benefit plan is and the role it can play in your financial future. Please note that cash balance plans are generally combined with a 401k defined contribution plan. So please review the One Future 401k plan summary video in advance or shortly after you view this video. I'm Peter Rowe, that guy on the right. My partner Brandon Oliver and I serve as the plan fiduciaries under our firm Arkwood Financial in assisting you to monitoring the plan operations and the retirement plan providers, which in this case will be Money Intelligence. If you're interested in coupling the defined benefit with your 401k, each plan, even though they are separate plan documents, we'll use the same plan provider for ease of coordinating all the plan operations. So let's take a minute to discuss where the cash balance plan can be a part of your financial future and also review how they're different from the 401k profit sharing plans. So your primary reason for wanting to contribute into a defined benefit plan is if you wish to consistently contribute a higher dollar amount than what's allowable under the 401k profit sharing plan, which is highlighted here for this plan year. Now, structurally speaking, the cash balance defined benefit plan operates very differently than a 401k. 401k plans are what's known as a defined contribution plan, which means that your future benefit is dictated based upon how much money you're able to contribute each and every plan year. Conversely, a defined benefit plan, your future benefit is created today, and then your contribution limits are structured around meeting that future benefit at some point in the future. Now, it's also important to know that a defined benefit plan is an employer-sponsored plan, which means that if you have any W-2 employees, then those individuals are going to be subject to a required minimum contribution by yourself, generally speaking about 7.5% of income. However, if you also have a 401k profit sharing plan, any safe harbor non-election or any type of profit sharing contributions that you have to that plan can be used to offset the minimum contributions in the defined benefit plan. There are a few other notable differences between a 401k profit sharing plan and defined benefit plan. First, with the defined benefit plan, there is no fixed annual contribution limit. Your contribution limit is going to be structured around how old you are and what your future benefit is going to be. So for as an example, we might have a younger participant who might have a $75,000 annual contribution. We may have an older participant that might have a $250,000 to $300,000 annual contribution. Second thing important to know is that the investment rate of return is stated inside the plan document. So as an example, let's assume that rate of return is 5%. If the underlying plan investments earn more than 5% during the year, or on the average throughout the years, that is going to be reducing how much money you can contribute into the defined benefit plan because your investments are going to be making up the difference. On the flip side, if your average annual rate of return is lower than the stated annual interest rate in this example of 5%, your contribution rates will go higher because you'll have to make up the difference from where the investment rate of return didn't meet the required rate of return for the years. Also know that the defined benefit plan does require a commitment, meaning that these plans need to operate for a minimum of about 3 years. Now, the IRS does not define what a minimum time frame is. It's just an industry standard that's been accepted that about a 3-year plan cycle is acceptable. However, it can be based upon each individual plan. So by layering on a cash balance plan on top of your 401k profit sharing plan, you have the opportunity that you can substantially increase your annual contributions to you or to key members of your team. These plans do couple well with a 401k profit sharing because any contributions that you're providing to any staff or W-2 employees, as an example, a 3% safe harbor or even a 5% profit sharing plan, those contribution amounts in the 401k to your employees will be offsetting what your required minimum contributions would be for the defined benefit plan. So as an example, let's look at two individuals. One individual is age 45. And they wish to add into a cash balance defined benefit plan to their financial future. They will be maxing out the defined contribution plan at $66,000, which is split between the $23,500 for the 401k, profit sharing at $43,500. And their age with their defined benefit contribution could be $100,000, giving them a sum total of about $166,000 that they can contribute. Now, as another example, let's look at a 51-year-old. So because they're over 50, they can contribute up to $30,000 into the 401k. Profit sharing contribution remains the same at the $43,500, but also because of their age and possibly a benefit difference at retirement, they can now defer an additional $200,000 into a cash balance defined benefit plan, giving them a $273,000 contribution limit for this year. Now, please note when we're looking at compensation that is eligible for defined benefit as well as profit sharing 401k plans, we're talking about income that is subject to the W-2 payroll taxes or subject to self-employment income. Thank you for listening on how a cash balance plan can be an important addition to planning for your financial future. If you have any questions, please connect with Brandon or myself as needed, and have a great day.